All right, my friends, watch out for people trying to sell you on whole life insurance, heaven forbid, universal life insurance, or anything in this day and age which is giving you extraordinarily high yields without any risk or minimal risk or anything like that. These are always the times that bother me about the whole life insurance industry. Because they always say, well, my whole life is paying between 4 and 6%. And I'm just telling you right now, it is not unless you have a fully funded policy. And we'll get in that here in just a second. Universal life, you want to stay away from. If you have a policy, you better make sure that sucker is funded. You better get an in-force illustration. An in-force illustration. Let me write that down. Oops. I hear my boy playing games over there. In-force, like the force be with you, illustration. If you have a universal life, you want to get an in-force illustration. Now, a lot of people think they have whole life, and they actually have UL. All right, UL means the policy is not guaranteed. Universal life means the policy is subject only to you and how much money you put in. And the facts are, as the cash value drops, the likelihood of your policy terminating before you do goes up. That's what the in-force illustration will do. It'll tell you what the solvency of the policy is under current interest rates, current expenses, and then worst case scenario, in terms like you got no interest and higher fees, and then if you got no interest in current fees. So there's usually three things in an in-force illustration. They're going to show you what you're currently getting relative to what you're putting in, relative to your death benefit, the whole thing, which is good. And if that looks like it's going to expire, and what that means is if the cash value goes to zero and you're still alive, this policy is dead. It's dead to rights. The policy is not solvent. It's not funded properly. And so the in-force illustration, so you have three things. You have your current. If the cash value goes to zero before you die, and it's a lot of assumptions on when you're going to die, it might show you the cash value goes to zero when you're 95 years old. Well, if you're comfortable saying, well, if I still have a policy when I'm 83, I'm pretty fine with that. That's okay. That's okay. Just recognize there is a risk that the policy won't be there at your death. Just keep that in mind. Now, if it shows the cash value stops at 76 and you're 75 right now and you got 5 more years to live, this is bad. You're in a bad place for sure. So just remember that. So current, it looks at your current record, i.e. what they're currently paying on interest, what the current fees are. Worst case scenario, the highest fees they can charge you contractually with no interest, and then it says no interest with current fees. All right, so keep that in mind. And if two of the three are going to zero quickly, you need to have a discussion with your insurance provider to say, what do I need to do to either make sure I don't lose all my money, or what do I need to do to make sure this policy stays solvent? And you can do a couple of things. You can reduce the death benefit. You can increase your premiums. You can cash the whole doggone thing out. Just be careful, because once you cash it out, you have no life insurance. So I'm not telling you to do that. I'm telling you to get an in-force illustration. That's universal life. Whole life, on the other hand, is guaranteed as long as you make the premium according to what the initial rules of the contract were. It's a unilateral contract. As long as you do your part, pay the premium, the insurance company must do their part, provide a death benefit with a guaranteed amount of cash value. So whole life, you don't really need to get an in-force illustration so much. But if you want to prove that you're not getting 4 to 6% interest on your cash value, that's fine. Because I can almost guarantee you'll show you have cash value in there, and you'll show you're putting $100 a month in each and every month, and you'll show 10 years from now that you did not get a 4% to 6% net interest rate. I can almost guarantee you that, unless your policy is heavily funded, which has a lot of cash value in there on the front end. Most people's policies are not heavily funded. I'm just telling you right now. So these guys are out there saying, oh man, we're getting 4 to 6% cash value life insurance. Well, here's the way you do it. And this is what I always say to people. All right, well, if that's true, then what will your cash value be in 10 years? And we'll just do it. And I've done this illustration a couple times. I had a guy about 2 years ago who was new to life insurance who was saying, I represent a company, it's Mass Mutual. He didn't say that, but I was able to figure it out because I've been in this business long enough to know what the sales tactics are. he says, I represent a company who pays 4 to 6% interest right now each and every year. And that's really. I said, well, what would if I dropped in $100,000 today in my whole life insurance policy? All right, let me make sure this is dry. If I put $100,000 in there today, what would my cash value be? That's my initial premium, what's called a drop-in premium. You're dropping in premium. All right, so I'm saying, okay, guy, I'm going to give you $100,000 today, drop in my whole life insurance policy. I have $200,000 of death benefit, whatever it is. We're not talking even about the death benefit. We're talking about the cash value. What will it be in 10 years, all right? And if I'm getting 4% a year, and I'll even just do simple interest. I'm not even doing compounding. It should be $140,000. That's just at 4% because he's saying 4.426% on average in 10 years, right? In 10 years. And in 20 years, it should be $180,000. Again, we're not even compounding. We're just doing simple interest, right? What will it be? And in 10 years, it was like $95,000. That doesn't sound like 4 to 6% net interest. In 20 years, it's like $120,000. In reality was, this is what it should have been, just at 4% simple, not even compounded. It's like, I don't know, like $95K and something like $120K, whatever it was. And I said, so how are you selling off 4 to 6% a year guaranteed income interest rates when in fact that's not happening? And he said, well, you have to factor in fees, you have to factor in commissions, you have to factor in all this. I said, okay. So if I say to you, I will give you an account that has a guaranteed 4 to 6% interest on your cash, and in 10 years you come away from that account with less than $100,000, you think that will fly with the regulatory agencies? The answer, of course, is no, because it doesn't give you 4 to 6%. That's a crediting rate. I could care less what your stupid crediting rate is. I care what my net rate is. After fees, after commissions, how much am I netting on my whole life insurance policy? Now, the thing that this guy should have said, he was new, he didn't know, is that after this year, after year 20, you are probably going to get, probably not 4 to 6, probably 3 or something like that percent, because essentially the cost of the contract are now are minimal in terms of what's called the net at risk. That's at risk to the insurance company. So basically, the insurance company recognizing that you've paid so much money into this, you have so much cash value into this, that they're paying back the commissions. All the commissions that you have paid have already been paid out to the guy who sold it to you. There's a lot of cash value in here that's accumulating on itself as well. It's a funded policy, and there's less and less risk. They call it net at risk is what it is to the insurance company. So what happens in life insurance, no bunny, no puppy, is you have a certain amount of money at risk to the insurance company. And as that amount gets declining because your cash value is growing, let me show you what I'm talking about here. Illustration might help you. And look, just for the record, I do not think whole life insurance is a scam, not in the least. I'm a big fan of whole life insurance. I hate the sales tactics that say you're going to get 4 to 6% a year on cash, because it's just fraudulent. It's simply not true. So let me just go into this real quick. How insurance works is what's called net at risk. All right, and not at risk to you, mind you, net at risk to the insurance company. And with a cash value life insurance policy, even a term, but a cash value was called a permanent insurance company. When you start out, you have, we'll just say, $250,000 death benefit. That's a death benefit. That's a life insurance, but you only have, $250 in cash value. All right, so the net at risk is huge. All right, so net at risk to the insurance company is $250,000. Does that make sense? Each and every year, though, you're building your cash value. Now you got 500, and now we're going to say you have probably not 500. We'll say you have $50,000. Now you got $200,000. All right. So what happens here is the net at risk drops, because as this goes up, the cash value, the death benefit goes down to the life insurance company. And so as the death benefit declines to essentially you got 50,000 net at risk here, is that the cost of insurance, the COI, drops as a cash value that you have increases and the death benefit stays the same, or essentially what's happening is the amount at risk. So in this case, there's only $50,000 at risk to the insurance company. The insurance company's only on the hook for $50,000. Here they're on their hook right here for about $250,000. And so they have to charge you what's called a cost of insurance accordingly. The more net at risk to the insurance company, the more risk there is, which means they have to get compensated for it by the cost of insurance. So with whole life insurance, what happens is the more cash you accumulate in your policy, the less at risk to the insurance company, which means the less cost of insurance, all right? So after 20 years, generally speaking, the cash value is such that the net at risk insurance companies drop significantly, which means there's less at risk, which means there's less cost of insurance. After 20 years, all the commissions that have been paid to the broker gets, it was used to be like 66% of first year's premiums. I don't know how it works anymore, but basically they recoup those commissions within 10 years essentially. So basically after 10 years, all the commissions that the insurance company paid to the broker, which you're being charged, get wiped out. So you no longer have that. You have less cost of insurance. What was the other thing too? So you got commissions, the broker cost of insurance. Now there's another thing too that goes in the, usually is a load. On every time you put money into the policy, is usually a 3 to 5% load. Even USA had a load of commission, essentially is what it is. It's not really a commission to a broker, it's a commission to the company who sold it to you. But anyway, so what happens, at some point you got enough in here that you don't need to put any more assets in there at all, because it's fully funded. It's endowed essentially, which means it can never go away relative to the death benefit that you have. So at this stage, you probably are getting, you're still getting a 4 to 6% crediting rate. It's actually got 6 today. It's probably about 4. And after cost of insurance, which is basically in the administrative fee, that's all they got. You're probably getting about 3 1/4 on interest once you have a significant amount of assets in there. And this is why I cannot stress enough that you have to have this thing funded, which means you can't start with a $50 a month payment when you're freaking 55 years old and expect to get 4 to 6% as a rate of return on your cash. It's not going to work like that. Now, some people say, well, if I drop in $100,000 on the front end, because I have so much cash in there to beginning with, I should be able to get a 4 to 6% because I'm putting so much cash. No, because you still have to accumulate, or you still have to pay for the commission of the guy who sold it to you. No one buys whole life insurance. It's all sold to them. Doesn't mean it's an evil product. It's like no one really buys annuities. But what happens is they got to pay somebody to sell it to. And even the insurance company's getting paid here. All right, so even the insurance company is making money. So someone's getting paid. Someone's getting the commission essentially. And they have to recoup that in a higher, I don't hate to say the cost of insurance, but they're recouping that by giving you a 4% crediting, but taking back, in this case, in the first 10 years, they're taking back 4 1/4. All right, so I hope that makes sense. Stay for part 2. I'm going to go over some other numbers that you need to know when it comes to being, this is safe money that you get more than CDs and stuff like that. Hold on just a second.